The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Before we get into the technicals, let's have a look at the main themes out there. And of course, US President Trump's tax cut and spending bill has narrowly passed through Congress. The bill would add $3.4 trillion to US debt over a decade and push millions of Americans off health insurance. It's also going to fund the president's immigration crackdown, make 2017 tax cuts permanent, and deliver tax breaks promised in Trump's election campaign, amongst other things. Well, the jobs data did push US markets to record highs. The non-farm payrolls came in unexpectedly hot, with 147,000 jobs added in June, the unemployment rate falling to 4.1%. The non-farm report followed conflicting data from ADP, which showed private payrolls unexpectedly fell in June, the first drop in more than 2 years, while wages growth also slowed. The Atlanta Fed President Raphael Bostic says rates may need to stay on hold for at least a year. Bostic also saying he only expects one interest rate cut this year, while markets are now pricing in September to start rate cuts and 2/4 point cuts by the end of the year. And the US trade deficit expanded in May because of a jump in imports. US importers may be stocking up ahead of a possible increase in tariffs on the 9th of July. Let's delve into the technicals now with Ilya Spivak from Tasty Live. And of course, all of this, especially the jobs report, Ilya, leading the S&P 500 to another record.
Very good to be with you, Juliet. And yes, indeed. It's a quiet week here, of course, in the U.S. because we have the Independence Day holiday. So the markets are going to be off tomorrow, and it's been very low volumes. In fact, we got this rally in the S&P on the second lowest volume day for the year so far. So there's not a whole lot of conviction here, but I wanted to take a look at the longer term view. We are, of course, just starting the second half of the year here. And if the first half was about a growth scare initially with the rollout of the tariffs and then a kind of crescendo in early April, and since then, of course, a spirited recovery, the second half may be a bit different. As we see the market making these highs, we look at the relative strength index here on the monthly chart, and it's starting to show negative divergence. And that's when you see it elevated and then doing that has been something that tends to give you a little bit of an early nod at maybe some loss of momentum that could lead to the forming of a significant top. And of course, the last time we saw something very similar like this was out of 2021 going into 2022. We've seen similar sort of things in the lead up to the sell-off in 07, in 2000, going into the breakdown that was COVID. So these are not very frequent signals, but when they appear and when the market is setting higher highs under these circumstances, it does bear watching. Momentum might be flagging here, and this is something that may not be a rally to chase.
Yeah, indeed. All right, what are the bond markets telling us? Because we know they're always ahead of the curve, Ilya, and you're seeing a nice head and shoulders pattern in the 10-year.
It could be, and that, of course, lines up with the signaling that we just got. You just mentioned the comments from Raphael Bostic. We, of course, got a little bit of a warmer jobs report. In fact, even the prior number was revised a little bit higher, which is out of step with how we've seen this happen recently. April's numbers, for example, they beat at the headline, but then, of course, the previous number over the preceding 2 months was revised down by 58,000 jobs, and before that by 38,000. So definitely an encouraging set of numbers. And against that backdrop, bonds came in, yields came up. But if we look at what Fed funds futures are showing us, there's a very serious disparity here between what the Fed is saying, which is 2 cuts this year and 1 cut next, from the latest summary of economic projections after the FOMC meeting in June, to what the markets are showing, which is those same 2 cuts this year, and then 3 cuts or maybe even more next year. So the markets are envisioning some kind of an economic downturn that's going to make the Fed act much faster and to a much greater extent than the Fed itself has considered. And that would be in line with what we're seeing here showing up on the longer term. This is the monthly chart for the 10-year bond. It could be congesting into a head and shoulders pattern here, which would be a very significant bottom. And if we took out that neckline there to confirm the pattern, we're at about 4.3 and change on the 10-year for the yield here. We could be going as low as 3.5. And if the pattern were to fully give us what is implied in the setup, possibly as low as 2, because whatever economic downturn the bond market is sniffing out could lead to some much more accelerated easing than the Fed has told the market so far.
Now, Ilya, if I wanted to come visit you in the US, it's looking like a good time at the moment.
Yes, indeed. The US dollar has been absolutely battered since the beginning of the year. In fact, it began against virtually every currency at the start of 2025. And we're getting into some interesting levels, in particular against the Aussie. Obviously, we've had quite the spirited few months. This is now, 6 months in a row of gains for the Australian dollar. And that's, of course, in line with what the dollar has been doing, the US dollar more generally. But we're coming up into this very interesting area that's defined the move lower for the Aussie on a multi-year basis, going back to the peaks in 2021. And we have an interesting setup here where it looks like we've taken out some congestion. We have room to maybe extend higher into the 67 and change area, approaching 68. But then we come up on this very important level. And we have a kind of dual set of questions here. We just looked at stocks. They might be getting a little toppy. We just looked at bonds. They may be starting to carve out a bottom. And for the Aussie, this is a very interesting situation because, of course, it tends to be vulnerable to risk-off sentiment when stocks fall. So this would be an interesting point of reversal. But also, if U.S. yields come in, then that would shift the yield structure against the U.S. dollar and in favor of other currencies, including the Aussie, though, of course, the RBA is just getting started on rate cuts as well. So this is a very auspicious spot here. If we can get through this resistance, we could be looking at the start of a multi-year Aussie rally. And if we fail right here, we could be looking at the next big leg in the multi-year decline. Either way, this is a very interesting moment to be looking at it.
Indeed. And Ilya, given that it is the public holiday tomorrow, your time for July 4, what are you expecting more broadly in terms of how investors take on risk ahead of that long weekend and given that the bill has passed Congress?
I think we're running out of reasons to focus on the headlines and not reassess where we are for the global economy. And that, I think, is probably the next phase for markets. We've, of course, had all of the back and forth on tariffs. It doesn't look like the markets are terribly concerned about this July 9th cliffhanger that we have coming up. It doesn't look like they're terribly concerned about the August one with China. We had the bill go through. We had the geopolitical tensions in the Middle East flare up and simmer into a basically U.S. enforced ceasefire. So at this point, it really is that disparity with stock markets at the highs and the bond markets screaming that actually the Fed needs to start cutting because focusing on inflation is the wrong thing and focusing on growth is the right one. That disparity really starts to become glaring. And if the markets were to consider that this is where the bond market is pulling us, and so this is what it's seeing, we could start to see a very different narrative emerge as global growth dynamics really come into focus. The Eurozone, of course, anemic still, China anemic still. If the U.S. economy were to falter, there is no plan B, there is no safety net. That wouldn't be just a U.S. recession, it would be a global one.
All right, Ilya, have a fabulous long weekend. Always appreciate your insights. Ilya Spivak there from Tasty Live. That does it for this edition of The Trade. Be sure to join us on Monday.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.